A backdoor Roth is a strategy for getting money into an IRA if you've exceeded the income limit to contribute directly. I'm happy to be your guide today as we cover what a backdoor Roth is, how to create one, and how taxes work with them, including the pro-rata rule, which does complicate things, but don't worry, I've got you. Grab a notebook, a pen, your calculator, and let's get into it. If you've made over $144,000 in 2022 or $153,000 in 2023, you are no longer allowed to contribute to a Roth IRA. In order to get in, you have to go through the back door. Step number one is to open up a traditional IRA if you don't already have one, or you can use an existing IRA that you already own. Step number two is to put your money into the IRA. A note on this step is that if you already have a traditional IRA with pre-tax money, meaning you've received a deduction when you put the money in, then the pro-rata rule will apply when you do the backdoor Roth, but we'll get into that in a bit. Step three is to call your investment firm's support line and let them know you'd like help processing a Roth conversion. This is technically what you're doing when you move the money from your traditional IRA into your Roth. I've got a video coming up soon explaining Roth conversions, so be sure to subscribe if you're new here. Step number four is one that your investment firm does on your behalf, and that's to move the money from your traditional IRA over to the Roth account. They may have you open up a Roth, or they may automatically open one for you. When they process the transfer, they code the account as a conversion for the IRS. Now let's get into how taxes work with the backdoor Roth. Remember that with a Roth IRA, you don't receive a tax deduction for your contributions, but in retirement, both the contributions and the growth get to come out income tax free. This is the benefit of going through the process of doing the backdoor Roth. With a traditional IRA, you receive a deduction when you put money into the account if you fall under certain income limits set by the IRS. If you're at the point where you no longer are allowed to contribute to a Roth directly, you're definitely past the point when you can take a deduction for your traditional IRA. This is why you'd especially want to get your money over to a Roth so you benefit from that growth coming out income tax free later. This is a great calculator that'll show you how powerful those tax savings can be over time. Enter your age, your income, your current savings, and it'll pop out how much you benefit from getting your money into the Roth, which is the green. In this person's random situation, they save over $1 million. But even if you have less invested, like let's say you have $10,000 invested, your tax savings can still be $200,000. Enter your numbers and you'll probably see that it's worth it to do the backdoor Roth. There's no cap on how much you can make to have the ability to contribute to the traditional IRA. There's also no income limit for being able to convert the traditional money to Roth money. So that's what makes the backdoor Roth a tax loophole and something to take advantage of while it lasts. Let's look at two scenarios to understand how taxes work with your situation. First, you don't have an existing IRA with money in it. This is when things are really simple. Just follow the steps that I listed earlier and you're done. There's no taxes owed since you never received a deduction for putting money into the IRA. Now, second, you have an existing IRA or multiple IRAs that you've made contributions to and received a tax deduction for. Perhaps they were established when you were at a lower income tax bracket, or you rolled money from an employer-sponsored plan to an IRA. The backdoor Roth gets complicated here because the pro-rata rule applies. This means you'll have to pay tax based on the proportion of after-tax versus before tax contributions that you've made. What happens is the IRS looks at all of your IRAs as one to determine how much gets to come out income tax free versus taxable. This is good so you don't get double taxed, but it does make the process a bit challenging. Let's look at Amanda as an example to determine how much tax she'll owe. You can plug in your own numbers to estimate your taxes here. Amanda has an existing IRA with $30,000. Some of the funds come from a prior 401k and some were deductible contributions she made in the past when she was eligible. Let's say Amanda wants to get $6,000 into a Roth via the backdoor conversion because now she's making bank and no longer allowed to put money directly into a Roth, and she doesn't qualify for a deduction in a traditional IRA. She puts the $6,000 into her IRA or opens a new one. In either case, the IRS lumps all the IRAs together, so it doesn't make a difference which she does. Now, the total of her IRAs is $36,000. First, let's figure out how much of the $6,000 will not be taxed. To do this, we take $6,000 and divide it by the total balance of $36,000, which equals 16.6%. We multiply that by the $6,000 and get $996. This is the non-taxable amount of the conversion. Now take Amanda's $6,000 and subtract the non-taxable amount of $996, and you find the taxable amount of $5,004. This is the amount that will be added to Amanda's income to determine how much tax she'll owe for the year she does the conversion. Now, Amanda still moves the $6,000 into a Roth, and there will still be $30,000 in the traditional IRA, but of the $30,000, now $5,004 has already been taxed. So in retirement, that reduces the amount of tax she'll pay because calculations will be done to determine how much gets to come out income tax free and how much should be taxed. Each year going forward, the same process needs to be done. It will be really helpful if you keep good records so you don't end up double paying tax at some point. One way to avoid having to do this is to convert the entire IRA balance in 1 year and deal with all the taxes at once. This may bump you into a higher tax bracket depending on the amount though, so you will have to run some numbers to help you determine your best approach. Another way to avoid this is through a reverse rollover, where you move your IRA into your employer-sponsored plan. You do have to check and see if this is allowed, but it could be a great way to avoid dealing with the pro-rata rule altogether. Let me know in the comments if this video was helpful, or if you have any questions at all, I'll be sure to answer those below. If you need help determining how much money you need to retire comfortably, I show you exactly how to calculate this for yourself in this video next. Thanks so much for watching, and I'll see you on the next one. Bye!